Hey, what's up, guys? Hope you're having a good day here. We're going to be starting the session with Nic Chahine, options mentor here for the Options Inner Circle chat room. We're going to be starting in about 25 minutes. Don't go anywhere, guys. We'll be starting soon. All right, guys. So we're going to start here a little bit earlier. We're going to give you guys a special treat here. Okay. We have here Nic Chahine in the house today. How are you doing, Nic?
I'm doing great. How about you? Did I make you nervous logging in late?
Yeah, a little bit. So I heard about the Apple call, the Apple trade in the chat
Oh,
room.
yeah, that was pretty cool. Yeah.
How did that go down?
Well, all day we watch levels in the chat room, and particularly one of the things I was watching was Apple. And here, let me see if I can bring it.
I'll pull up your screen if you want.
Okay, I'll do that then. All right, let's do that. So anyway, we were watching the levels on many tickers, one of which was Apple's, always in the foreground because it's a heavyweight and you have to pay attention to it. All right, so hopefully you can see my screen there. Okay, and let me see if I can bring it from outside. So this snapshot is going to come from an outside, higher resolution monitor, so it might look a little big. Hopefully it'll work. Okay, yeah. All right, so this is a 5-minute chart on Apple, so relatively short term. So the high yesterday was 155.00, and Apple did this, and then boom, it rallied, and then it did some sort of a flag here, and I was tracking it, and I said, the S&P had its own thing, so I was tracking this to see how it can bring about the breakout in the S&P, which is what we were tracking and trading. So we bought the dip in the S&P in the morning, and then we went to. It didn't work out the first time, and then immediately we had that little whoosh down. I don't know what happened, but then we recovered, and then it went ballistic, obviously. So that trade worked out, but I was watching Apple for that. So I said, watch Apple. It could be the game changer that the S&P needs in order to go ballistic, and the QQQ as well. There was a trade there. So 149.99, it got stuck there for like 5 or 10 minutes, right? So I said, this is your chance, Apple. As soon as it prints a high above this guy, it's going to go. I had no idea that it was going to go with 20 million shares on a headline. Now, how does the headline know to break out like 30 seconds after I say, get ready for Apple? I'm not watching the news. I had no clue they were going to have a headline, and they came out with a flying car, basically. So you don't need the news. We were ready for this breakout before the news broke out. We had no clue. I was engrossed in the chat room and 16,000 different charts, no news on my feed, and this happened. So this is proof that you don't need the news. These candles are called equivolume. I don't know if I'm pronouncing. So the fatness and the height of the volume bar and the fatness of this candle shows that it's huge volume. So this is the volume close, which is usually about 5-6 million. So this, I believe each of these is 6 to 7 million shares. So that's a huge breakout.
Yeah, that was an interesting trade, definitely. And so yeah, I mean, if you want, let's just go ahead and start with your review of the markets and everything else.
Sure. So let me see here. This is the S&P. Let me zoom out. So the S&P, first of all, whenever I do a trade, you know me, when I share it in the chat room or via email to people in the chat room. So what happens is I start with this. What does the macroeconomic picture look like? What's the world look like within which the stocks and the trade? So if I focus completely on the opportunity, so if I look on PayPal all by itself, I'll say this is a blind buy. But then when I add to it that the markets they've never been higher, then this is not an obvious point of entry in size for anything, right? It's a good trading opportunity. But if my 90-year-old mother tells me, I want to invest all my money into the stock market, I'll say, maybe not now, Mom. Let's wait a little bit. So it will affect the rest. So PayPal might be down here relative to its high. But if this one does a 3% dip, 2% dip, 5% dip, PayPal may trigger some sort of a bearish thing and drop. So before I focus on the opportunity, I'm using PayPal as an example. In PayPal, I have to first look at the world, that PayPal within which it needs to trade. So the world is the S&P, for example, the stock market. It's in the hands of the buyers. The bulls are in charge. Every dip has been bought. The September dip was about 5 days too late to being bought, but it got bought. So now we know that the dips are buying opportunities. That is a fact. So then I go to the individual opportunity. So if I was looking at PayPal, I would look into PayPal and I say, okay, now we look at the micro. What does PayPal look like today within that opportunity? Oh my gosh, it's falling off a cliff. Why? A couple of things. They reported they grew a lot, but somebody expected more. So maybe that expectation level was wrong. And then they piled on with the Pinterest buyout thing. So now people are thinking maybe they're looking to buy something. But technically, it's falling into 2-3 months worth of consolidation. So this whole zone, they should be buyers lurking there because whoever bought it here made money last time. So they remember that, they want to repeat the performance. So if the markets hold up, it's not time, it's too late to panic out. If somebody wants to nibble long, that's fine. I am long. I had greens. I didn't book all of them, so I left some. So I'm long mildly by a debit call spread, which is, we can touch on that. Using options, I risk, I think it was $2.20 per contract. So if I did one, it's $220 to make about $800. You know, that's the idea between now and the middle of January. So it's not like I piled in thousands of dollars into it. I could have done one contract or 10, depends on the level of conviction that somebody has. So that's what we do all day in there. So the macroeconomic conditions have not changed, right? We know the Fed is tapering. We know the Fed is probably going to start raising rates maybe next year. I bet not, but that's the prevailing meme right now. How can I track that in real life? I can look at what the dollar does and what the TLT does. Why? If the Fed is going to hike rates, currency gets strong. The dollar should continue rallying. I am long the dollar, but from a long time, and it's painful to see the greens trickle in a little bit at a time. So if the dollar strengthened, that means there's rate hike pricing into the market. So now if we see that and the market is also rallying, it means the market came to terms with it. They're not scared of the rate hike. It's already known. They moved on. Variations of it will tell you differently. Like if they say, oh, now we think about 3 rate hikes, well, that wasn't on the table, then they might reconsider that. The TLT would be also a clue, because if it's rallying, that means yields are falling, and yields fall usually when rate hike talk go away. So today, the TLT popped, not today, did it? Yeah, today, last 2 days. By the way, in the chat room, I said I would get long the TLT on that day right there. And whoever did it, it had one dip, and then I said, I'm not doing it, but it's doable. And then it dipped right after I said that, but then it did what I thought it would do. And I said, I would get out here. But anyway, rallying TLT means falling yields, which means that the rate hike fears talks are dying. If you want my opinion, there's no way yields are going to go high because of until Europe changes its payout on its bonds. I believe currently the bonds in Europe are still negative. So if you go to buy bonds in Europe, you have to owe the government money on top of it, which is, I mean, I would like to meet the person that does that. So they're forced to buying the US bonds. That's what's called TINA. Then there is no alternative acronym. And it's in full effect because the higher yields go in the US, when the 10-year bond, I think the TNX is the 10-year, yeah. When the 10-year bond pays you 1.7%, why on earth would you go buy the European bond that costs you money? So by definition, you have to come buy this bond. And if you come buy this bond, the yield falls. That's a fact. So if there's bids on the bonds, the yields are not going to go anywhere. So it's like catch-22. There's no way we're going to have runaway yields unless something breaks in the economy. All right. So is that enough helicopter level talk for you, or do you want more?
That was pretty good, Nick. That was pretty good. You always have an interesting take here on the markets. And what have you guys been up to there in the chat room as in general, as far as like, maybe trade scouting?
Sure. Today, I mean, this week we've had dozens of ideas of what I can. It's like a kid in the candy store. Oh my gosh, look at this one, look at that one, look at this one. So today we had a few puzzles. Alibaba was one. So yesterday, you know me, the earnings trades are complete guesswork. Like we don't know what they're going to say as far as earnings, and we don't know how they're going to react. So if you read the headlines on this drop, I read the headline that said slowing growth causing Alibaba to fall. I think that was almost verbatim what the headline said. I was like, holy crap, they shrunk sales. Yeah. So slowing growth. No, if you read the headline, they grew 29% year over year. So the point of every business is to do better than last year, right? They did 29% better than last year, but the headline said slowing growth. So, shocker, right? If you read the headline, they grew 29%. What they meant is that they used to grow faster. They did that to Amazon for 10 years. Every time the rate of growth slows, they cause an alarm. This is a company that's under fire from the government, and they still managed to grow 29%. I bet you they fudged their numbers to look worse than they are. I can almost guarantee you they did that because they want to not be high profile. That's what got them on the hot water. We're doing so well. We're doing so well. They probably forecasted weaker than actual. They probably fudged their numbers through the kitchen sink. They always have, what do they call that? Line items on the P&L where they can hide stuff. So they probably took out all the garbage and threw it out. They took advantage of it. Anyway, so this is a company that is, no other company can produce the amount of revenue like it does, not even Apple. In one day, $100 billion in one day. That's just insane. So, but anyway, yesterday, the conversation, what kind of lottery ticket would you do on it? I said, I wouldn't invest in it, but if you want to play something fun, and if you're guessing up, then put a debit call spread and buy a small put spread to recoup your cost. So if you're right, it should rocket. And if you're wrong, it should drop, and then you make up some of it. And that's exactly what happened. So I did it. I never do earnings. So I guessed up, and I had a call spread. And then, of course, it did this. But I also had a small put spread, $3 white put spread that I paid 40 cents for. And that priced to $2. So that offset almost entirely the cost of the call spread. And now I still have my call spread, which is worth almost nothing, but it still has, I think, 30 or 40 days still left on the clock. So that was what we did. And it's guesswork. And I said, this is a guess because the better trade is after the fact. And sure enough, today I shared a trade on Baba. I said, if, and these are big, important ifs, if, number one, I am not loaded long in all of my portfolio and hurting, then I could consider this. And then second, if I'm not already long Alibaba, I could consider this. In other words, I wouldn't add to pain in my portfolio that looks the same as what's in pain right now. And of course, that includes I wouldn't add to any Alibaba existing trades because I don't know if this is going to hold. And that's my thesis, that this will hold. And if not, I'm out. So if I took a long today and tomorrow it's below this one, I think there was one little bit lower prior. Yeah, so if you don't stop here, then you have to ride it and decide if you stop here at 130. So the smart thing is to get out here and try again. So that's a trade. And I said I would catch the falling knife if I wanted to, if I'm not long Alibaba and if I'm not long already something like Alibaba and in pain. And how would I do it? Depends on the person. I always share 3 or 4 things, right? So the one is I can buy shares. And the other 2, I can buy stuff. One is buy a call, which is not what I would do in this case. Buy a call spread, which would be the second thing I wouldn't do. Or sell a put to own shares. And not everybody can do that. But the alternative, which is probably the best thing to do, is to sell a put spread. We'll talk about that a little bit later because if people are here, they're saying, what the heck is he talking about? We'll go into options and describe what that means. First, we'll define what options are and all of that. So, you know me, I'm all about charts, but really the way you can put the charts to use is if you go ahead and execute with something, buy shares or use options to make some money off of that. All right. So let me ask the people in the room, give me a 1 if you've never done options, so I know how to word things. Oh, before I forget, if you don't follow me on social media, shameless plug, I'll give you my handle in a second. Let me see. A whole bunch of ones. All right, we have Andro 2, Matthew 2, New 2. Okay, we have a few 2s and a whole bunch of 1s. Justin, Troy are 2s. Oh, a couple of Nicholases there. Well, that's the same one pushing twice. All right, so fair enough. I got it. Fair enough. Just learning. All right, Matthew, that's cool. I will speak to everyone at first by saying the basics as to defining what options are, and then we'll go from there. We'll expand on the conversation. Usually your questions and your comments will lead me to veer the conversation properly. So, all right. So by the way, I am at Racer Nick, no K, on Twitter or StockTwist, whichever you're at. All right, let's go to options. That would be a good transition. So I said, I like to use charts. I'm super strong at charts, but by the way, my background has nothing to do with Wall Street. It's I was an electrical engineer and then got into finance, and here I am. So I'm definitely not your typical Wall Street guy. So I will not necessarily use Wall Street terms. And yes, I do use a crayon when I draw on the charts. And if you look at my charts, I don't have many indicators. In fact, I only have one that I use, and that's one up here. That's the volume profile. My best asset is finding levels. So my best tool are my eyes. I just look left, and that's that one trade. The thesis is that this should hold. It held last time. And if it doesn't, I'm out. So find levels that matter. Okay, so before we get started into options, I want to define risk. So you're saying to yourselves, Nick, come on, man. I know how to define risk. So I'm going to give you a second to tell me, how would you define risk? If you were teaching a class and you needed to define risk, how would you do it? I'm very confident that all of you will get the one part, losing money, not losing money, you mean? Will get the one part right, but I like to put it in a way that makes it like it's almost like an aha moment, taking bold decisions. Well, that's reckless. What you can't predict. Okay, I see that planner right there. Okay, John got part of it right. Losing opportunity, Sunil, maybe. Go ahead, don't be shy. There's no wrong answer, I promise. Low risk, long-term investment. Low risk, long-term investment. I like the way you're thinking, Thomas. I can do that. Profitably, do it without knowing. That's recklessness. You can take a risk if it's calculated. Not be afraid of what you can't predict. Okay, risk versus reward. Nicholas, you're on the right path there. Support level is my risk. I like it. Yeah. Ooh, Derek touches up on the second part. Okay. Gambling. Diane, we don't gamble. I tell you what, Diane, we'll make money off of gamblers, and I'll explain to you at the end. If I don't, remind me. Okay, I'm going to save you. Right there, Kendall. Right there. That's the second part that nobody talks about. All right, so let's go. So risk has two parts in my book. I usually word it that way to myself. That's how I keep myself out of trouble. And here's the thing. If somebody comes to me, I'm in trouble with this trade, most of the times, if they had taken the time to set it up right, that's the best defense before you even start with the trade. Then you have fewer chances where you need to defend. So number one part of my risk is everybody got it right. Almost everybody. How much can I lose? What's on the line? What's the consequence? What happens if I'm wrong? The worst case scenario. Okay. This is where that part of the decision. So everybody says I'm managing risk, and I'll tell you what part you manage. That's not it. This part, you sit down and you debate it with your household. And you say, am I okay to risk $5,000 on this trade? If they say okay and you say okay, then you put that to work. And now you've already accepted the $5,000 risk. I'm making that number up. 500 for a smaller account, 100,000 for a bigger account. I don't know what it is. So you establish what is okay for you to lose, and then you play with that money. The second part is you assign yourself a percent. What are my odds of winning or losing? So that's important. Once I set this, I'm done. That's the part I manage. Because when you take a trade, like if you decide, okay, I want to go Lucid, and you bought Lucid, you must have had in your mind, hey, I have a 50, 60, 70, 80% chance I'm going to win for whatever reason. You did your homework. You found out Lucid is doing something that most people are not. So you think that you're smarter than 70% of the people out there. Therefore, there's little chance you're going to lose because you gave yourself an edge. Okay. But that edge is perceived because that's your opinion. And that's how you manage that edge. Time goes by, and then you find out that, hey, everybody else was on board with that Lucid idea that I thought I was the only one. And then you start, maybe I didn't have an edge. So you drop that number in your mind. And then it comes to a point where it's like, okay, so now it's at point X. It's way lower than my what I'm comfortable with. I should be out. Not easy, right? Because when you're not using options, that number has to come from your mind. Here's the beautiful part about options. That number is written on a piece of paper for us every second, and it's updated on the second basis. And so I don't have to guess what my odds are. All I have to do is read it. It's on a piece of paper. So all I then have to do is when I take the trade, I choose a percent that works. And then you try it. If it doesn't work, you tweak it, and then you come to a point that works for you, and then you do over and over and over and over and over again. I share mine because they are statistically viable. So what I do is I use the percentage that puts me as the house, and the rest are the casino players. So when I deploy risk, I make sure that the odds are 85 to 88 to 92% in my favor. That's how you can use options to gain an edge. You can still trade stocks, but know that when you buy a stock, your chances of success are statistically 50% because the stock can go up or can go down. You think you have an edge, say plus 20 points because of the homework you did, but the other person who's doing the opposite of what you are, like if you buy a stock, somebody sold it to you, they think the opposite. So they think you're an idiot. You think they're an idiot. It's a competition. You don't take it from a shelf, the shares you buy. You don't put them back on the shelf, the shares you sell. Same with options. There's always the other side of the trade, so to speak. There's always the other side of the trade. So keep that in mind. This is so important for any trade, but for options, if you live by this scenario here, if you live by this where you establish the dollar amount and you're cognizant of it, and then you move on, and then you establish a winning formula that you've used before, a percentage of what are my odds. If you can assign yourself an odds, however you end up trading, even if it's buying equities or shorting equities, I hope you don't short equities, but if you do, or you buy land, or you're doing sports, if you're jumping a gap, hey, I can jump the gap. Let's see, is it 3 feet deep? So I can maybe I'm not going to get injured too badly, but if it's 3 miles deep, I could die. Then I don't do the jump type of a deal. And then what are my odds of clearing the gap? So this applies to everything in life. But here in options, it is so simple and straightforward. All right, so if everybody has a handle on risk, I'd like to introduce another concept that I want to share that's pretty important in the SPAC days. So SPACs, most of them, not all of them, please don't take offense if you love one, and I'm going to just tread on it here, don't have a current income. That's the definition, right? They have money and they're looking for something to adopt that has an income, or something that is building an income, like an EV company that come to market. It doesn't have an income now. What is it? Fisker, I think is that they're building one, so it's coming, but right now they have nothing as far as income. So that is a situation where it's a speculative bet, because by definition, it doesn't have anything. It doesn't have anything going for it right now. So it's not an insult. The type of risk is speculative. Like QuantumScape is probably the best example because it's a binary event. They are trying to accomplish the almost impossible. I'm an electrical engineer, and I think they can't do it. In fact, I shorted it the other day on a pop on thesis saying, I think in the end, they're not going to be able to do a solid state battery to use in an EV on a marketable scale. I think it works in the lab. I don't think it works in real life, but that's my thesis. And I shorted it that way. So it's a binary stock. They either do it or they don't. If they do it, they go to the moon. If they don't, they go to zero, basically. So I didn't short it to go to zero. I shorted it using options, very mild, finite amount of risk. I did not sell the stock short. I'm not an idiot. Okay, so what I'm getting to is don't average down in those stocks. In fact, averaging down is not a good idea. Here's how you modify the average down concept to make it a better idea. If your trade size is 100 shares, then take a 50 share position at once. And then if it falls, then you add the second 50. So that's not averaging down. That's breaking up your entry into two pieces to have the best outcome. But if you usually take 100 and you take all 100 here, and then the stock drops to here, and you add another 50, now you made your problem bigger. That's not good. I know a lot of professional traders, none of them average down. In fact, that's a no-no in their book. I'm not telling you what to do. I'm just telling you what the pros don't do. So sometimes you can average down if you're an active trader and you know charts and you know it's hitting and it's going to bounce, then you average down to get out of the whole position. That's fine. Anyway, so that's one way of doing one thing, one little tidbit of what not to do. And definitely don't average down in something iffy. My best friend from childhood, we were friends since we were 5 years old, averaged down in 1999 in a company called Webvan. Okay, it went out of business. So he averaged down and down and down and down, and then he ended up with nothing. But imagine that. It was a great business. Grocery deliveries from the internet. Yeah, who does that now? Let me think. Everybody. So they were early and they died, and his stock died, but he averaged down. If he had averaged down in Apple, he would have made a bundle. That's the difference. Okay, so those are the points to make. So let's get that out of the way. Let's jump into options. All right, so don't get scared. This is Rivian. Hey, I'll keep it here. Why not? So Rivian is a new company to Wall Street, very active. And the options just became available, I believe, this week. In fact, this contract right here, by the way, this is E-Trade practice account. I'm not recommending E-Trade. It's a good practice account that I have. Which platform is better, best? Use, and they're free to use. Try them out and then pick one that you like. They all are good. They all suck. It depends on what time. You know, for a while, this one, every morning you couldn't touch it. It wouldn't trade. Nothing would fill. And then now it's gone. So anyway, so I know you're laughing at Rivian. It's still up from the opening day. So you can laugh on all you want. But you say sinking. I say retesting neckline. So we'll talk about charts in a little bit. You know, there's nothing to be ashamed about this price action. This was wrong. So correcting, giving back some, that's fine. There are a lot of support levels here. So again, this is one of those speculative stocks that I wouldn't average down. So if I bought it here, I'm not buying more here. Back to options. Okay, let's talk options, not charts. All right, so look, these the options, I'm going to avoid using Greeks. You know, you've heard options and you've heard Greeks. I'm going to avoid using Greeks. When you say, how can you teach an options class without using Greeks? I'll tell you why, because it's not necessary. I'll teach you what I know about the odds without having to learn what the hell they mean with those fancy terms there. So options are contracts. So there's a buyer and there's a seller. They have a term. Every contract has a term. You know, this one has 1 day left on the clock. This one has 1 day plus 1 week. So this one expires tomorrow. This one expires next Friday, the Friday after that, the Friday after that, middle of December, I believe the 17th, week after that, January 21st, March, whatever, middle of March, middle of June, January of 2023, January of 2024. Okay. So what does that mean? They have a whole bunch of contracts is what it means. Not all stocks have all of these contracts. Some have more, some have less. Okay. This company just got options. So what are these contracts for? I'll go to this one. This one has 8 days on the clock. You want me to make it bigger? I don't know if I can a lot. So we'll go, how's that? Better? Okay. So here is the thing. So the contract has two sides. You've heard the word put and you've heard the word call, maybe. And you've heard the impression that these are bearish, the puts are bearish, and the calls are bullish. Not so. Both can be both. Depends on what you do. If you buy it or you sell it, and why you're buying it and why you're selling it. And I'll put a little more logic to it in a little bit, but first let's define it. You've also heard a term, they say something like most options expire worthless. So this is where you say, okay, so take me to the classroom that's teaching how to sell options. You're in the right room, my friend. That's what we're going to do here today. That's what I like to do, is sell options with a little bit of a smarts. All right. So buying options is a loser's game unless you're super good and super lucky. If you do it super responsibly, you can definitely succeed. But if you do it willy-nilly, you'll say, what happened to my account? With that one big major blow up, you will bleed here and here and here and here, and then pretty soon your account will be gone. But with a little bit of work and discipline and a system, then you can control the progress you're making. If you're in it to think you're going to take because you saw somebody last year take 500 to 40,000, okay, maybe it happened. In fact, there were 3 or 4 people in the chat room, they said they did that. And the funny part is they had the exact same numbers when they came to me. Hey, Nick, I've had an account, started with 500 and now it's 42,000 and I forgot the book. It was like literally the same numbers, like weird. Those are not the typical results. We're here to establish something we can do and replicate in up markets, down markets, sideways markets. This market here is in transition. Everything is new. It's a Wild West kind of a deal. So we'll put some smarts to it. Back to the definition of a put. I'm going to use the put side to explain from a protection perspective. So let's say I bought 100 shares of Rivian and I'm okay taking some losses, but like our friend here said, keep falling. What if I want to protect myself and stop out at 105? Let's say I don't want to lose. I want to be out at 105 in the next 8 days. I expect something big next week or whatever. So what I can do is I can go out and buy this contract for protection. All I have to do is buy one contract, because in options, every contract represents 100 shares. All options, any ticker, any company. Every contract is for 100 shares. So for normal contracts. So this one will cost me $350 because it's 100 shares for one contract. So it's 350 times 100. Okay, so what does that entitle me once I do that? It's like you paying Geico $350 to insure your asset, in this case, stock, for 8 days. So if the stock falls to 90, you can call up Geico and say, take my shares. Geico will have to take them. They can't refuse them. So you will quote, exercise your right, because that's what you bought. You bought the right to sell your shares at that level. Okay. I just did more. Somebody wants to scream bigger. Then we won't be able to see a lot. Then I'd have to shift left and right and people would lose the logic. So are you on your phone? If you're on your phone, transition to a desktop. It's unfair to force everybody to be on a larger scale. Okay. So if it goes to 90, I'm guaranteed a sale at 105. And for that, I pay $3.50 in order to reserve that right, but it's only for 8 days. So this is an expensive proposition for this stock because of this guy right there. This implied volatility, if you've heard of the VIX, this is like the VIX for that contract. How nervous are the markets about it? the higher the number, the more expensive these are. Like usually this should be like 30, 40. By usually, I mean like for a normal stock, like a NASDAQ stock. For boring stocks, it should be like 25. In this one is like 3 times the normal active stock in the NASDAQ. So it's pretty expensive. So buying is a loser's game, or at least it's a gambler's game, because I can make a lot of money fast for somebody that's using them to make money, or they can lose all their money overnight. So, or most of it. All right. So that's to try and define it. It is a contract that affords the buyer the right to sell the shares at 105. So this is an insurance policy for the buyer. So who is giving them that insurance policy? The seller. Who is the seller? I could be the seller. If I did homework, let's say I liked Rivian and I said, dang it, I missed it up here. I wish I could have bought it at 105. Did you hear that last part? Wow, check this out. So I wish I could have bought it at 105. See that my dashed orange line? I swear to you, I did not plan this. This is an alert to myself, and I don't even remember having it there. But look, it's set for 106, right? So, and I blindly chose 105 here. So I would be the seller of that put. Why? Because I told the chart to wake me up when Rivian gets down to 106. I might be interested in going long. So if I wanted to buy the shares at 106, I would sell Jenny out there her protection at 105. If Jenny wanted to buy puts to protect her shares, hey, Jenny, don't worry about it. I'll buy your shares. And that's the transaction. Her money goes into my account, and I have a credit in my account for selling the put. No money leaves my account. Jenny pays the 350. I collect the 350, and I'm on the hook. And if 8 days tick by and Jenny doesn't call me and says, here are my shares, that 350 is mine. If the price falls to below 105, in fact, it doesn't need to fall to below 105. Jenny can exercise her right to stick me with her shares any point in time, but it would be idiotic to do it before the price falls significantly under there. So if she exercises her right and the stock is still at 110, she can do that. But if she does that, she gives me immediate profits. When she buys the put, she does not need to own shares, but that's a different reason of buying a put. But I'm explaining the put concept from the protection side. This way people, get a grasp as to what a put is. We'll talk about how you can use it to trade if you don't own shares. Okay, so she's the buyer, I'm the seller. We're both bullish. Let me explain to you why. I want to buy the shares at 105. That's why I sold the put. She wants to keep her shares unless something happens, and that's why she bought the put. We're both looking up. If she was truly worried about Rivian, she would dump the shares, right? So puts are not necessarily bearish. You hear it on CNBC, and they steer people the wrong way. Think about it. Okay, so who's selling stuff? Market makers. Those are the smart people. They don't lose. So if they're selling stuff, that means the buyers are going to lose. So when they say unusual options activity, you should go chase it. They're sending you to a place that's going to lose money, because for it to make money, the market maker has to lose money. So how do you make money on those calls? Ahead of time they're going to say it. Otherwise, you're going to be late. I guarantee you that. 90% chance you're going to lose money on the deal unless you're super fast and you jump on board right away and you profit from the next sucker who comes after you. So be careful as to which options you trade. You can trade unusual options activities if you have your own feed of data and you find it. So if you subscribe to a service that gives you unusual options activity ahead of time, yes, that could work because the suckers will follow it. Okay. So, but if you're late and you saw it on TV or you read it in a tweet or something, it's already done. The easy work is done. Okay. So the put is protection. And if I own shares, I could buy it to protect myself because it guarantees me a sale at that price for a number of days. All right. So let's go through and the headlines and let me clarify them for you because they also go towards explaining what the puts are and what the calls are. So I already talked about the implied volatility. It's giving you the value. The higher the number, the more volatile the stock, the more expensive the thing is. Like Today, Alibaba, let's go to Baba. Let me go here. And I'll come back to Rivian. If we went to Alibaba, today's contract, they reported overnight earnings. And this number must have been higher. And as soon as it reports and it opens, the number shrinks because the event is gone. So then the question marks around the event are gone. So this distance was way bigger yesterday. This is the going rate. This is what the dashed line is, what it should be. The solid line is what it is. Yesterday would have been much bigger discrepancy between the two. But since they reported, the implied volatility shrunk. So back to Rivian. So the implied volatility tells you what just happened. Oh, okay. So look, the implied volatility for this week's contract, look, 300% almost. For next week, it's calming down. If you go out in time, it should be even lower. Oh, still holding. Okay, so another thing is the open interest. What does that mean? That is the current open positions in that contract. You're showing zeros, Nick. What's up with that? That's because that's the first day this contract is available. Yeah, we'll go through all of that, John. I'm just defining what options are. You're talking about selling covered calls. We'll get there. So open interest means when we woke up today, who had what contracts, inputs for this week for Rivian? Nobody, because that contract came to market today. This was not here yesterday. They added it. So the zeros. This is what happened today, volume. There were this many contracts that exchange hands today, buyers and sellers. So tomorrow, exactly at the open, these numbers will move to here and these will go to zero because now we would have open positions, which is called open interest. And it's a static number. They won't update it until Monday. It's an overnight update. It's the static number. This is the dynamic number. So tomorrow, this starts with zeros and then it starts going up. And then Monday, these numbers will change these numbers and will click back to zero on the Monday open. So you have the same columns on the call side. So now we know the difference between open interest and volume. Is this important? Yes. This stuff comes up in the chat room all the time. I have a giant spreadsheet that downloads all the data for the indices and I share them. So I say, I saw downside pressure for this week. So I expected whooshes down. And today's dip may have alleviated that downside pressure, but it still exists. So tomorrow morning in the chat room, I'll pop in and I'll share my write-up before. By the way, in the chat room in the morning, I usually share, let me see, they're supposed to not be here, but they are here. So I share, hopefully I can find it pretty quickly. You see all these contributions? That's a video on a trade for Twilio. That's a conversation about Clover dip. And let me see here. That's the intraday trade on the S&P, like what levels you're going to chase to make money on it. That's a trade setup on Baba. I'm trying to find something specific. Okay, that's how we knew that the SPX was going to break out. The is going to break out next is when the VXX crashes. These are 5-minute charts, by the way. Some of the conversations are 5 minutes. This played out to a T. That's the Apple line we were watching. That was an Amazon question. Anyway, I can't find it now. So that's the dollar. That's the first setup this morning on the SPX.
Yeah, for those guys that are asking about the chat room, I put the link in the chat for Nick's chat room where he's basically doing all these option trades. He gives you the weekly sessions on Sundays just for the chat members. And we are giving you guys a complimentary laptop as well included. So this would give you access to Nick's exclusive trading chat room just for options.
So this was early in the morning. Let me see here, 8:24. I'm on Pacific time. So market had been open. I shared this shorter term 5-minute chart on the S&P. There are a lot of people that are active in here and they like to make money on the fast. So that's not my jam, but I'm pretty good at it because I read the charts well. So this was the range in the S&P. So I said, Okay, so we have clear, stop doing that thing. We clearly have where I put the line in the middle. We have a line splitting the action. And I said, we're coming into it from higher lows, higher lows. So I said, here's what's going to do. We're going to do this. We're going to come here and break out. And that's exactly what happened. And then the breakout was above 4,700. So whoever went long right here caught whatever, 15 points and maybe more tomorrow. They used the IWM to do that, some of them. Somebody asked me about some strategy with the RSI. I shared this with them, although I personally don't use it, but it is definitely a RSI trade setup. So anyway, coming back to my point is in the morning, I will share the strategy, which will update us on the open interest. This is somebody else contributing their VIX thing. Oh, I can't find it. Anyway, back to down here. Okay, so Rivian, what were we looking at? This. Yeah, so the open interest is important because it gives you, they say, put your money where your mouth is. That's where the money is in the open interest. So if most options die worthless, then I expect that this is going to be resistance on the way up. So just an easy way of looking at things, simplifying things. Okay, next would be the most important thing. I told you earlier, I gave you a little tidbit that the odds, remember the risk where you have the amount and then you have the percent, what are my odds of success, is given to us on a piece of paper. There it is, bonk, delta. Okay, so this is my odds maker. I live and die by this. Why? So the delta definition, if you want it, I don't think you need it. It's something like the amount that the contract will change based on a change in $1 of the underlying. So they're saying, how does this contract change in value when this changes $1 up or down? Ugh, right? So who cares? To me, here's how I see it. What's the price? 123. So somewhere around here. Look, it's not a coincidence. This is 50.5-ish. Ignore the minus. The puts are minuses. The calls are pluses. What does that mean? It means 50.5. Those are my odds. There is no edge. If I buy it, I have no edge against the seller. If I sell it, I have no edge against the buyer. We each have equal opportunity to win or lose. There's no edge. So my setups are usually selling risk, selling puts, selling calls, or call spreads, or put spreads, I should say, not selling calls. And I start my trades where the delta is in my favor. So let me reword it. Somebody that buys, to answer a question first, somebody said, do I need to have shares in order to buy a put? No. I forgot the name of the gentleman that said, die for a Rivian drop, Rivian. So if he wanted to short Rivian without shorting stocks, he could go out and buy this thing and pay $250 for it, $240 for one contract. So if he's correct and Rivian is going to fall to 100s or towards 100 quickly in the next 8 days, so he will be rewarded handsomely, because that $240, if Rivian drops fast, will turn into 600, 500, 800. If it falls like to 80, it'll be maybe 1,200 per contract. And there are 5,300 people that did that today. So 5,300 contracts that did that today. But remember, that doesn't mean it's bearish, because the seller wants to buy the shares there. So it's support, right? Because as soon as it hits there, that seller of the put wants the shares, right? So they're interested in buying the shares. So that's, don't read into it too much. Make sure you know your own levels and have your own thesis. Don't trade the freaking headlines. So I could buy the put not having shares, and if the price falls, I can sell the put more expensive. So if I buy it for 250 and the price falls, it turns into 500, then I sell it. I reverse the trade and I just sell it. So I can just say sell it instead of buying it. And then the difference between the two would be my profits. I paid 250, I collected 500, I made 500. Made 250. So that would be the delta. So if I went and bought this, what are my odds of winning? Can anybody tell me? I'll give you a second. That'll be a stretch that you guys figured it out already, but I'll be impressed. Yes, boom. Good job, peoples. I love it. We got some pretty smart fellas here, or people, I should say. Yes, thereabouts. Yeah, it's a pretty rough, close estimate. You're going to have to put some body language into it based on your knowledge and the implied volatility. Sometimes it's even less because they're so nervous that once they calm down a little bit, that number will get reduced drastically. I mean, like everything will be less exaggerated. All right. So here's the thing. So if I'm buying this, are the odds in my favor? No, correct. No, the odds are in the seller's favor, right? They have an 85% chance of winning. I only have a 15% chance of winning as a buyer versus seller. So now we understand the concept of odds. That's why options are so exciting. Not because I'm a gambler. I hate gambling. I'm a terrible gambler. Okay. So when I buy, yes, correct, Thomas. When I want to buy something like a call or a put for whatever reason, I want to make sure that I buy one that has a good chance of yield of coming to fruition. Like this is better. This is even better. This is a sweet spot for me, like 0.33. It's cheap enough of a lottery ticket and it's close enough to 50%, right? I don't want the coin flip because it's too expensive, $800, $900. This is a lot cheaper and it's right there, right? I could do this, but this would need, another leg of. So when I want, like, if I'm shorting the stock and I'm buying this to short the stock, I want to guess the direction down, but I don't want to have the direction down be big. So the worst case, if you spend $500 and the thing falls but doesn't fall far enough, then you lose anyway. You guess the right direction and goes your way and you lose anyway. Okay, so the buyers are at a disadvantage when they're doing these low deltas. Imagine somebody buying, okay, so this is not a good stock for this. Let me see here. Apple is pretty boring. Well, not today, it isn't. Shoot. Google? Now let's go with Google. I'm trying to show you a low delta. Yeah, okay. So somebody that buys tomorrow's Google 3050 call. So the way they look, 11,000. What? So this is, talk about a lottery ticket. So it's not expensive in Google term. So here's what happens. Okay, that's a pretty good example of jumping into the call side. I'll thread everything together, I promise. Today, Google was up 1%, almost $3,000 a share. This is Google L. And this contract I'm showing here expires tomorrow at the close of day. Okay, so if you wanted to bet up on Google and you're not using options, you would have to spend $3,000 per share and buy however many shares you want. Or you can buy one of these calls and make a bet on 100 shares of Google. Okay, so where was that contract? Okay, this one. So this one has a delta of 0.085. So there's less than a 10% chance that this could happen. And there were 12,000 almost contracts that exchanged hands. So they were there at 2,000 already. Let's say there were 2,000 people trying to get out of their positions, 2,000 contracts closing, but there were this much interest in it. So somebody's expecting a big move on Google tomorrow to make money. And the other person is saying there's no way it's going to happen by selling it. So the buyer said, oh my gosh, tomorrow we're going to wake up, Google's going to be up big. I'm going to spend $150. And then I could make maybe $600-$700 per contract, because if it does jump, that $1.50 will be up big tomorrow. And on the other hand, the other side of that trade, somebody's saying there's no way Google can get to 30.50 tomorrow. That person has the odds on their hands. The other person is playing too much hope. Okay, so that's like, but that resolves itself by tomorrow. So tomorrow morning, the open will be fun for these people. And then throughout the day, how the stock moves will be even funner. So this will be an interesting thing to watch. And look, they were like, okay, now I get it. So maybe somebody did some sort of a spread where they bought 2 of these and sold 1 of this. So they would make, it's like a spread type of a deal. We'll talk about that later. But that was a good example to show you what a call is. So let's define what a call is. All right. So why would anybody buy a call? Let's not use this one. Go back to Apple. Okay. So what is a call and why would I want to use it? Let's say I wanted to buy Apple, but I don't want to pay $160 per share for 100 shares. That's a pile of money. What I can do is I can reserve my price at today's price by buying one call. Okay. So if I buy one call, remember earlier we talked about puts, now we're talking calls. Me, the buyer, I reserve my right to buy the shares at 160. I don't need to own shares already. That's the point. I want to buy them, but not today, but I want to lock myself in. I paid 5.6, which is $560 because that is one contract for 100 shares. And what happens next? I'm in control. Do I have to buy shares? Not at all. I'm in control. It's like buying an insurance policy. You don't have to file a claim. If you get into a wreck that doesn't cost a lot of money, you don't file a claim because it's going to raise your rates lower, right? So I'm in control. Just like buying a put, I'm not forced to sell the shares, that I'm in control. So price rallies, it goes to 175. I call up my broker, exercise my right to buy the shares at 160. I'm immediately $15 in the good, but I paid $5, so I'm $10 profitable. Or I don't even buy the shares because if it does rally to whatever I said, 175, that $6 will be like $1,200. So the $560 will be like $1,000, $1,200. I don't know how fast it's going to rally. I don't know where the VIX will be because that affects prices too. But all I have to do is just sell the call I bought. And if it's for more than 600 or 560, I made money. I didn't even need to buy shares. So that's the kind of trouble that people get into. They see these dangling things. Oh my God, I'm going to make so much money. I'm going to buy this one here. They go and buy this dollar one up here. And now, the delta is what? 20%-ish. It's not ideal on a day when it's up that much. So they're overpaying because these are hot on an up day. It's not good to chase stocks. So this is a tougher one. I would rather spend 400 or 560 than waste my money on this one and end up losing anyway, right? So be careful of what you buy, puts and calls, be purposeful. So I'm going to give you a lesson. Stop. Let's do another lesson. So the first lesson was the definition of risk, and subset of it is not to average down, right? I'm going to give you another one that I use in the chat room all the time, to all my members for years. Okay, so this one, put it down, write it on a sticky note, put it on your forehead if you want. No, you can't see it. Put it on your monitor. NT. What does that mean? It basically I want to stop you from taking a trade without purpose. No trigger, no trade. As simple as that. If you don't have a trigger, you shouldn't have a trade. You're saying, I don't watch charts. Okay, so no thesis, no trade. And just so you know, I think it's going to go up. It's not a thesis. I think it's going to go up because blah, 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 blah. Okay. So if that person that talked about Rivian, I'm picking on you, they have a thesis about Rivian, bearish thesis. Who am I to argue with them? That's their own prerogative. So that would be a valid reason, but not because it's gone up so much they want to short it. That's not a thesis. So it is no trigger, no trade, or no thesis, no trade. In other words, have a real reason for taking the trade. Here's another stupid qualifier I have. I used my mom earlier. If I cannot recommend it to my mom, or if I cannot take money from my mother to take it, I probably shouldn't take it from myself. So in other words, why bother with the iffy trades? Just do fewer trades that are solid and stand behind your work, and make sure that only a where did this come from type of a mistake can make you lose. In other words, cover all the variables that you can, and only, like today, I got surprised by Teledoc. Okay, today's drop in Teledoc, I'm still doing some homework. It's like, what the fudge happened, right? So I want to see what happened. So that's the kind of money that my trade was super green and it went to red. like in an instant. So those are okay because I didn't make a mistake. There was a surprise something that came out. So no trigger, no trade. No thesis, no trade. Have a freaking reason. Okay. Lesson over. Enough with the talking head. All right. Where were we? So let's recap. We defined puts. If I buy a put, I buy the right to sell shares at that number. Do I need to own shares? No. Traders buy puts to quote short stocks. What's a call? I buy a call to reserve my price to buy the shares. It's my right to do so. I'm not obligated. Do I need to own shares at the end? No. I can simply reverse my trade and sell the call, maybe at a loss or a profit. Depends. The buyer's in control. What if I sell a put? Can I exercise early? No, you're not in control. You sold the put. If you're Geico, you're waiting for the phone call. You cannot say, hey, I heard you got into an accident. Here's your claim. You can't do that. So you just have to sit and wait for you to put the shares. I'll give you a story. Last year, I sold a put on US Steel X at 9. The stock collapsed to 4.8, and they never gave me the shares. 4.8 from 9. Like, why on earth did you buy the puts from me? I ended up making money. It was crazy. I should have lost a ton of money. I didn't, because somebody mismanaged their trade on the other end. So they don't always put you to stock, but if time runs out, the broker will automatically put you to stock. So for example, in the chat room, I don't want to say it's like 3 months ago, no more. Whenever the Boeing had the clearance on the 737 MAX. So somebody in the chat room sold puts in Boeing. Clearly they have a good size account because not everybody can sell a put on a high dollar stock like that. And for expiration on a Friday, and Friday came and the stock expired within a penny of his sold put. So the broker, he woke up on Monday owning shares. He was assigned the shares, even just a penny. He was assigned the shares. And guess what? The stock opened up 11% on that headline. So lucky day. It doesn't always happen like that, but getting assigned is not the end of the world. Now, selling puts can be dangerous if you do it left and right when markets are at all-time highs. I today had this conversation in the chat room. I promise you that I had this conversation in the chat room. Somebody shared a long list of puts they sold, and they're all expiring about the same time. Luckily, they have a few weeks, but that's a mistake. I wouldn't do that. I would scatter my risk across time. In case we have a dip, I don't have a fire sale on everything. At least I can jump in and manage my risk this way or that way. So having balance is good. What I'm saying here sounds super exciting, sounds super easy, but it's very easy to get wrapped up. This person is smart. They've done options before. I don't know why they did this, but it happens. So it's important for you to be in the right group to keep us from getting in trouble. Now, what happens in the chat room? That's what we do all day. They give me ideas. Let's see here. Trying to see if I can come up with something on the fly. Does anyone know on Webull? Okay, I don't know. I don't know what Webull. Somebody's talking about Intuit, so I'll check it out tomorrow. This was where the SPX closed. This was the high today. This was the poke that failed. So tomorrow, now we know 47.09 is to be chased higher to deliver probably 47.16 or 47.18. So we do better when we're trading in groups. And that's my point. I highly suggest you trade in groups. If not this group, find a group you like, make your own group. Speaking of groups, Sundays, I share out of my own time. I do it on my own platform, a meeting for everybody in the chat room. And what happens there is we review. I send you a form. Tell me all the tickers you want. And we will review them live in a webinar style like this one. And I'm going to tell you something. You're going to sell yourself on being in the group. And I'll tell you why. Because I can almost guarantee you that the hottest part of this presentation today will be when we start talking tickers. I already saw a few people asking me about Lucid. A couple more tickers scrolled by earlier. I forgot what they were. But anyway, I know I saw them. So that's what happens in the chat room all day. And as a result of the Sunday, and that's every Sunday, I usually say I want 1 hour, but guess what? When the list is over 100 tickers, it takes more than 1 hour. This was this past Sunday. The webinar had this many tickers, and these are the submissions from you. Are you reading? What's the lot number here? 115, and there were 2 that popped into the chat. We have Australian stocks, we have oil stocks, we have crypto, everything. So I collect this. This is the outcome of the video. I share the video, it's 2 hours long. And if you don't want to watch the video, I share this table and it's clickable. You click on it, you get the chart. So it's there. And it's a lot of fun, and it's a lot of trades come out of it. See, somebody's already asking me about Rivian. Josh, we'll get to that. When you say that, you're going to tell me, are you thinking of buying puts tomorrow and why? So all of that. You have to have a reason. So if you tell me buying puts tomorrow, I wouldn't buy puts unless it falls below 120.3. That's me, the trader. Where do you see that spreadsheet? I share it with I plop it in the chat room and email it to whoever gets my email. So you don't see it right here. I'm showing it what it looks like. So hop on in. It's a whole bunch of value there is. So as far as shorting Rivian tomorrow as a trade, let me see here. Hold on. Okay, this is more granular for it if you're an active trader. So they have support here. It's not to be shorted until this support fails. And when they do, then you look at the secondary support. So if I short it here, I'll get out here or trim here. And if it loses this one, it's going to accelerate. It has support here, and then maybe they fill the gap. But nothing happens until it loses this one. So in this instant, I would not be a short yet. The 5-minute chart shows the bears are in charge. And you can see, look, they dropped, consolidate, dropped, consolidated. So if that behavior changes, that means maybe they're starting to reverse, and that's how a bottom forms when you stop making new lows. Anyway, those are granular. All right, where were we? Lost track. Okay, reviewing what we did. We defined the puts. I shared an example of I sold the put and I got a sign it's not the end of the world. The future just opened and we made a new high. So on the call side, when I buy a call, it gives me the right to buy shares, but I'm not obligated to do so. Okay. So all of this is to say it's a plethora of opportunities. And this is just one contract, folks. I can do this on a one-day basis. I can do this out to 2 years from now if I wanted to. It depends on my schedule. Personally, I like slow trades that are boring. What does that mean? So I like to go to January, for example. If I wanted to sell a put in Apple, I'll sell it like 20% below current price, settle for a smaller amount of money, but for extremely high rate of success. Like this, there's a 5% chance only Apple will be below 126. That's the kind of chance I like to take. So I'd be a seller of these, not the buyer. Okay, that's my style. Or a credit put spread. What is that? So let's talk about spreads. Okay, so we can do, not Apple, it's not that exciting. Let's go to Rivian again. Why not? Let's see what kind of spreads we get with this one. December, we'll go to December, sure. Oh, wow, man, that thing is expensive. Okay, so let's say you want to bet up on Rivian. Okay, no, that person's asking they wanted to short Rivian. Okay, first of all, do you guys know how to short, like outright short? Why does GME happen, quote, the short squeeze? You know what physically happens with those? Not that I'm an expert in Wall Street, but I can tell you the thesis. So when you want to short a stock, not with options, the traditional shorters. So let's say you have shares, 100 shares of Apple, and I want to short Apple. I go out and say, hey, you know what? Give me your shares. Give me 100 shares. I'll return them. So you borrow the shares, you sell them, you pocket the money. The stock falls because you're right. You buy it back, you return the 100 shares at a lower price. You pocket the difference. Now, what happens when a GME situation and the stock spikes? Now, and on top of it, if there's not a lot of stock to go around. So then I, the shorter, panic, and I have to close my position and return the 100 shares ASAP at a higher price and eat the loss. I go out and I bid the going rate. Somebody says, no, I'm in the same position. I'm going to outbid you. And they pay over me. I say, no, wait, I'll up my bit. Buying begets buying, feeding frenzy. Who's going to close their short first? It becomes a self-fulfilling prophecy there and a lot of pain on the short side. So shorting with options, nowhere near the same. So let me tell you, when I asked you all, define risk, you all came in with how much money I can lose. Okay, so let me tell you why you should never sell a naked call. Never sell a naked call, because a naked call sold is like being short the stock outright. The platforms will let you do it, even if you don't have enough money to cover that situation. And yes, Belinda, that's what I'm getting to. The first rule of taking risk is to know what your worst case scenario. You don't know what your worst case scenario when you sell a naked call, because it could go as high as it's going and you're losing money the whole way, right? So I know somebody last week or this week who had shorted a stock that spiked. Wasn't Mara? Maybe it was Mara. And it spiked to 60. Is that Mara? Around $60. And they shorted it by selling a naked call. And they had to close out. Yes, it was. Oh my gosh. I bet you they're very upset. I feel sorry because they shorted it here somewhere and then it went to here. I told them, I think it was Mara. And I said, I would close it out, even though you think it's going to reverse, but you don't know where it's going to go. And if it goes like GME, you're going to go bankrupt. You cannot cover that short up there. And then they closed their short somewhere in the 60s, I think. So then it's good that they did, but look, if they held on. So somebody with a billionaire could withstand that heat, and all they have to do is just wait. They need to be right once, but not everybody can do that. So you hear of these big guys shorting companies. That's because they can afford it. We can't do that unless you have billions in the bank. You will be forced to close your position and eat the loss, and it will be massive. And you may be liquidating your account, even if it's millions of dollars. You need billions to withstand that kind of heat if it's a big position. Anyway, this was a breakout right here, and the measured move was right there. Let's see here, 44 to 23. The difference of that is the upside target-ish. All right, back to what we were talking about. So don't sell calls naked ever. I forbid you from doing that. Okay, let's say the gentleman there wanted to short Rivian. He said about buying puts in Rivian. So let's say he wants to buy puts for tomorrow. He would have to spend $300 or $200 to buy a put. Let's say he wanted to do it for a longer period of time. So he would have to go, say, to December. And that becomes a lot of money. So if I wanted to buy this put right there to short Rivian, let's say I don't own the shares, it's going to cost me $1,300 per contract. That's a pile of money. Okay, so what if instead of just buying it, I buy it, but I sell something else? So I still buy it. I spend $1,300 per contract, and then I sell something else. So that something else could be any one of these. So if I sell this one, now my entry cost goes down to $230. So how is that better? That now out of pocket, I'm only out $230 per contract. So to open this trade, it would show me I'm paying $230. So what's my upside? If I'm right and Rivian falls to 100 at expiration or close to expiration, that $230 turns into $5. Why? Because that's the value of it. It's $5. Why is it not $5 now? Because price is still up here and there's still 30 days on the clock or 29 days on the clock. So the faster it falls and the closer it comes to time, there's a whole bunch of things that will make that value change from 230 to 240 to 250. So I could make it wider. So now it's 600 to get in instead of 1,300. But now my maximum profit is much bigger because the spread is 110 to 95, right? So now if it falls to 95, I can make the difference between $6 and that spread. So now I'm making big money, but I'm spending a lot more money. So it depends on their goal and their thesis. If they see it in the charts, how far do they think the stock is going to go? That's how they decide which contract to take and at what level. Let's say they wanted to, let's see here, make it more of a lottery ticket. So they move both down. So now they have only a 25% chance they win, but now they only spend $200. You see how it works? So that's a spread. That's a debit put spread. That's a bearish position in the sense where if I'm buying it for trade, I don't own stock. The only way I can profit is if the price falls and quickly. So what if somebody does the other way around? And that's what I like to do. So the other way around, so let's say I am bullish Rivian or I am not bearish Rivian. Gosh, see, that's why when I zoom in, you can't see anything anymore. So if I'm not bearish Rivian, I would sell the put spread. So if I sell this put spread right there, I collect almost $100 for one contract. I'm going to round to one. And what does that mean? It means money goes into my account and I'm taking a bullish posture position. Why do I say it that way? So when you buy shares, you need a rally to win. When you buy calls or call spreads, you need a rally to win. That's the only way you can make money.
Hey, Nick, really quick here. Just want to congratulate here Melissa for joining here the Options Inner Circle chat room.
Hey, Melissa.
Shout out to Melissa. And quick question here from the chat. If they don't know how to do credit put spreads or any of the advanced trades, you have resources and you give them education, right, on how to do that?
Every trade, not to interrupt you, but to that, every trade comes with a 15 to 20-minute video from start to finish. I approach it, like I said, the macroeconomic conditions, the stock market, the micro, my thesis, what's the company look like, my thesis, why I'm doing it now, what would get me out, and then I explain how I do it. If I say, here's how I do it, sold put, I go through this process like I'm doing right now. And this would be like doing a put spread. I would say something here. If you want to preview, let's do it right now. Okay. So I would say, okay, today I'm going long Rivian and I don't want to fight the fight here. I know it's going to be active. So I want to go out to December and if I want to own shares of Rivian, and these are my words that I'll be using in the video, I'll say, you know what? If I really wanted to own shares of Rivian, and that's a big if, I would sell a put naked. Otherwise, nobody should ever sell a put naked. So what does that mean? It means that once I hit send and the old order executes, money goes into my account. Almost $300 goes into my account. However, and this is the super important point, if I cannot buy 100 shares, or if I'm not willing to buy 100 shares, I should not do this trade. I'll give you a variation. It's called credit put spread, but let's go through that one. So what happens there? So Rivian, I become long Rivian maybe. Why do I say that? Because I said I will buy it if it falls to, what was the number, 85? So that's down here. So it would have to fall and lose the opening price. It seems like an impossibility, but guess what? Stocks do it all the time. Okay, so it's not bulletproof, but my 80, it's even lower. My break-even point is 77. Why? Because the money goes into my account today. So maybe it falls to 75. And then I wake up one day owning shares at 80. Oh my gosh, you just lost $5. No, I didn't. I collected $3. So now my break-even point is $3 below that. So I'm only on the hook owning shares with a break-even price of 77. So somebody that bought the shares here is down from 120 to 75. Me, I'm only down $2. Okay. So that's the concept. That's why I'm saying I must own the shares. Otherwise, here's what happens. Okay. Price starts falling. This $3 turns into $1,000. So it shows a $700 loss on a $300 investment. That's huge. It scares the bejesus out of people. They panic and they buy it back. They say, oh, forget it. I want to take the bet off. And they buy it back. And now they turn a paper loss into a realized loss. Why? Because they weren't honest about owning the shares. If they were honest about owning the shares, they would stay cool, calm, collected, and they would just take the shares and deal with the shares after they get assigned. Because then when you get assigned, that position disappears and takes all the red paper with it. left with the $300 you collected per contract to buy the shares. Therefore, all the paper losses, the 1,000%, whatever it showed, gone like they were never there. And then you end up owning shares at a decent break-even price. So this could be a way to scalp, Sheikh, because I'll give you an idea, Sheikh. There was at least 2 or 3 just this week. So somebody wants to scalp a win on a stock that's falling, like Apple. Oh man, what call do I buy in Apple? I said, you told me you have a good size account. Yes. Okay, so you go out and you sell a put on a bad day in Apple, way out in time, way below current price. Why? I said, because if you can do that and you're willing to own Apple in the oh crap scenario, which rarely ever happens, then the next day when people calm down, small bump, doesn't need a rally, then you can buy it back and scalp thousands. But not everybody can do that, but it is how I would do it. For a decent size account to do that, but you don't need a decent size account to start. No, Tony, because what you can do, and a good transition, Tony, there. So I just described the process in the video. All this will be in the video, every video I send out as a trade setup. So if I cannot own shares, then I would do a credit put spread. So how is that different? Well, the different part is I can still sell the same one, but so I'm on the hook here because I promised somebody I'll buy shares. I'm off the hook here. So now from a account perspective, if the stock goes to 0, my maximum loss is finite and relatively small. I don't ride it from 75 to down, 77 down. I'm off the hook at 75. So I collect a lot less. I collect 85 cents. So if I do one, I collect 85 bucks. I'm risking $415. Whoa, Nick, what the hell? Like, okay, so let me rephrase. I'm going to yield 20% return on my investment, my risk, with 90% certainty, if not a little bit better than 90%. What? Okay, so the equivalent of this trade in normal stock terms, there's a stock that's going to give you 20% yield in 29 days with 90% certainty. You tell me you've got a stock like that, and I'll pay you a subscription. Okay, so there is no stock that I know that has a 90% chance is going to rally 20% in the next 29 days. It could do it even in half an hour, but not on a schedule. This is a statistically viable trade that has that. Moreover, to use one of Ben Bernanke's words, if I buy stock, I need a rally. This gives me the 20% if the stock rallies, gives me the 20% if the stock doesn't rally, gives me the 20% if the stock falls. Maybe I lose money if the stock collapses. So the stock will have to drop from 120 to below $79 for me to lose money. That's the reality. Otherwise, I'm making 20%. So for that, if I had a $500 account, I could do it. Just to answer your question. Of course, I wouldn't risk all my money on one trade, but that would be doable. So this is Rivian, not your typical starter stock. So if I've never done credit spreads, Rivian is not the one I would start with. Just saying, okay? First of all, that's the first week of options. Second of all, it's the first week of life in the public life. So, but this is to illustrate the point. I am not recommending this trade, especially if you've never done those before, okay? This is for educational purposes only to get the point across. So that is the bullish trade setup. Why is it bullish? Because it says crash is not coming. That's it. It does not need a rally to win. I have the odds in my favor. That's my bread and butter as far as trade setups that have a 90% winning ratio. When I share, if I share the table, the long table of trades, these are the ones that are money makers because they're hassle-free to a degree. They're not risk-free because if they were, they wouldn't pay anything. Okay, so back to the value in having the group. These trades, I have at least 3 a week, most often 1 a day, but let's say 3 a week, and they're full videos from start to finish. Throughout the day, if people ask me about tickers, they come with trade ideas. but not full-fledged videos like this. Okay, so trading in groups makes my watch list massive. You just saw how long that table was. That's not my watch list. If it was up to me, I would trade 6 stocks and that's it. And then I would do 5 or 6 trades at the same time and that's it. But because I'm answering literally hundreds of questions a day, then I'm forced to look at stocks, tickers with 4 letters and letters I can't string to VUSI and whatever, I forgot, BBVR or whatever it is. Anyway, so it's just things I would never trade myself, but I do cover with great pleasure. So sometimes I find a new ticker and I jump on board, like Palantir. This year, I found it from one of the members and I just fell in love with the stock, basically. All right. So we've talked about setups, and if you're a beginner, think about it this way. Think about a full-fledged options class that lasts a whole year, what it would cost with somebody being in a room with you all day, anytime you want it. Just think about it. That's in effect what you get here. I'm not a slave to the chat room, but I'm at the helm all day for myself. So I'm answering questions all day. And until the evening, I'm on California time. So I'm up at 4 a.m. for you. I'm off my rig at 6 p.m. In between, of course, I take breaks. My dog would bite me if I don't. But I'm fully dedicated to helping others become better traders and beating Wall Street. And that all happens in the chat room. So in the chat room, you're going to get a write-up before the market open with all the levels that I need for the day. That's what I was trying to find, and I just couldn't scroll up. By the way, there are enhancements coming to the chat room. Thank you, Benzinga, for that. I know it's not easy. But you will get a list of all the indices as far as ETFs and futures. There it is. There it is. Yes. Okay, so good morning. Today's plan. Small bounce, the options position this week showing downside pressure. I would likely buy the dip and I will share it. And that's exactly what happened. We dipped, I shared it. The first one failed. The second one played out and paid for the first one. I shared the charts for the ETFs, for the futures, and a handy dandy who's reporting type of a deal. So, and then after that, I showed the Fed speeches and I share, are they bullish or bearish, what they're likely to do as far as what they're likely to say. Are they hawkish or dovish? So, all right. That is part of being ready for the day. Before the day starts, I'm on board. I've got a plan, action. If the dip comes, I will jump in. They say, okay, where would you buy the dip? Well, it depends on how fast a trader you are. If you're on trading all day, then you can buy dips on 5-minute charts. If you're not, then you should wait for more substantial dips of like 2%, or it just depends. And I share them in write-ups too. Yesterday's write-up, I shared how to not protect. Okay, so I shared bearish trade setups. Why? Because my point yesterday, the lesson was, you have to keep balance in your portfolio. If your portfolio is all bullish, you have one bad week, your portfolio goes to crap, right? Especially if you do it with options. Okay, so if you do it with options, then one bad week would, if you only buy calls, would devastate your portfolio. If you own stocks, you can recover. You just have to sit on your stocks. But with calls, they just die, especially if you mistime them. If sold puts, they're just like having share, only better, because all you need is stabilization. You don't even need to bounce. You just need them to stabilize. And then the sold puts, if you put them in the right spots, they die for nothing. Look at my buy the dip lines. Those are alerts. I should put one here. It did fire today. There's one that fired today. I don't know which one. Okay, and I'll put one here. So it depends on how fast you are. I'm doing homework right now, so forgive me. Okay, so be ready. We help you do that. Set the trades. We help you do that. Look at your charts all day, every day. We do that for you. By we, I mean me. What else? Sunday webinars to review everything. And sometimes there are teaching moments. We do that. So yesterday was a bearish setup. So I said, if you have nothing but longs, you should infuse some balance. So I said, there are two things there. There's protection and there's balance. I said, you can rest assured that at all times, I should have balance in my portfolio. What is balance? Is having bearish positions that offset markets. For example, selling call spreads in the SPX out in time and close to 4,900. Yep, I can do that to December 31st. I can collect 25% yield at my risk. So they're saying, what if they go wrong? Perfect. It's balanced. It's supposed to lose money. It's supposed to offset your gains from the other stocks, right? So if they're both losing, then you set up your longs wrong. That's balance by selling bearish positions up there, credit call spreads, and I'll show you what those look like. And then the other side is protection. My favorite way to protect is using VIX calls. So VIX, you've heard of it. It's the quote fear gauge, not the VXX, not the UVIXY, VIX calls. They hold their value best. Look at it. Its average is 19. The lifetime average of the VIX is 19. So there was a period of time where it was under 12. That was abnormal. So, but it still has a bottom, right? So you're saying, why not the VXX? It's very active. Yeah, let me show you something. Why not? Would you own this? Is this a good holder of value? No. The VXX is going to zero. It is an ETN, not an ETF. Therefore, it's designed to expire, I believe. And in fact, it has expired. What happened here? I didn't want to record. Okay, I must have hit some sort of a sequence. Okay, that's what I was trying to do. VIX. There we go. So for me, protection, to protect my portfolio, I would prefer to buy VIX calls. So if I have a whole bunch of longs, I want to buy insurance, I will use January, like one of these. I think yesterday I said 17 or 18. So this was yesterday, $5.20, if I remember correctly. So I said, if I buy one, it costs me $500. But if the market, quote, crashes, that $500 explodes in value. Explodes. We did it before the crash in March. I kid you not. I was long the $16 call. And I closed it as a 5X because I didn't have a long position. And then it went to 90. So if I had kept it, I would have paid off 2 houses. Not in California, but maybe in Tennessee. So it is a way to, I share it every couple of months, because if I hold it for 2 months, it holds its value way better than buying puts on the indices, which is the other way I said. I said, if you don't want to buy VIX calls, I would buy debit put spreads in the indices. They cost about, I would go to December, for example, they cost about $3, maybe $2.50. I'll show you what they look like. Again, this is not a recommendation. What's price now? $4.69. I bet you if I go here, $4.67, $4.57. Okay, there we go. Trying to show both legs. Because we zoomed in, I'm going to zoom out. Sorry, man. Anyway, control minus, where's it's not working. Anyway, so there we go. There it is. Long day, sorry. So that's a debit put spread. It's $10 wide. I'm paying $2.50. In fact, I will snug it up a little bit. I'll pay $2.70. So if the SPY just has a 2% correction, this will be completely engulfed in the money. So price will be below $4.57, and this will turn into $10. So $270 turns into $1,000. Now I can calculate an amount to protect my account. I'm not trying to protect all of my assets. I want enough money to jump in and fix my trades. That's all I want. So how do I figure it out? How much is right? I don't have a right formula, but I can give you a logic. So look at on a bad day. If the market is down 0.8, 0.5%, and your portfolio is down 5%, then use that relationship on saying if the market was down 3%, what would your portfolio be? And you'll have an amount of money, right? So see how much of that amount of money you want to cover. I don't want to cover all of it, because then this gets expensive and this would start eating away at my potential profits. So, and I don't have protection all the time, only when I feel I need it. And it's a rental. I can change my mind 2 days later or a week later and sell it back for more money or less money. Okay. How do I exit? Physically, how do I exit? I reverse the process. of whatever I did. When do I exit? That question differs from person to person, because what's appropriate to me is not appropriate for you necessarily. I'll explain. What if I don't have any longs except the position I have? And what if you have 15 longs, just like the position you have? And you're asking me, should I close? I look at my portfolio, I was like, hell no. That's the only position I have and it's winning. No, I wouldn't close it. Meanwhile, you should, because you have 16 others like it, or close one like it. So I share the opportunity. You should be able to manage your own risk. This is not a trade alert service. I share my trade setups, but it's a learning process that lasts all year. I promise you, the value is there. And if you don't find it there, I also promise you that Benzinga holds up their word and gives you your money back. Am I right?
Yes, we do have a 7-day money back guarantee for the Inner Circle chat room here with Nic as well. So if you do want to try it out for 7 days, there is that guarantee as well for you guys to take a look at it.
I'm loving the conversation. I think Belinda is having a conversation with people. So this is different than stocks. Only how you trade. The method is the same. You can't go long stocks without a method, and you can implement it with options with a lot more freedom. I'll share an example. If I own shares of a company and I'm a little bit nervous, okay, I can use a stock replacement strategy. Okay, let's back up. Somebody asked earlier, fair enough. I'm going to answer you now. Covered calls. Okay, so if I own shares of a stock that has options with quite a bit of premium, like this stock right there, the SPY or Rivian, I'll tell you, somebody asked me today in the chat room, hey, Rivian is getting to a level where I think I'm going to buy it. And actually, he said, I'm going to sell puts to hopefully get assigned the shares. And if not, I'll make money. And if I get assigned the shares, I'm going to sell calls against my shares right away. That's somebody that's been doing options for a while. So here's the idea they came up with. They want to sell the puts to buy shares. That's super important. Let's say he does one and he sells this one. And he said, this expires tomorrow. Now, again, this is not a recommendation. This is somebody else talking to me. They wanted to sell this one. This will die tomorrow. If Rivian is not at or lower than 115, chances are he will not be put to shares. So he will make $200 just for selling it. If not, he has to buy Rivian at 115. And if it falls to 100, he lost $15 per share or $13 per share. Okay, so that's what he wanted to do. But he said, my strategy is not that. My strategy is to do this. And as soon as I get assigned shares, I'm going to go out and sell covered calls against it. But I'll show you that in a separate order. So if it closes at 115, he will go out and sell a covered call, maybe even next week. And what does that mean? So now he owns 100 shares, right? So he knows on Monday he's going to have 100 shares. So he can sell this one if he wanted. What does that mean? So by selling this call, mind you, he's not selling it without having shares because he's going to be put to shares. He's going to wake up Monday with shares. So he would sell this one. He would collect almost $600 right away. So if by next Friday, the stock is not above 135, this $600 dies in his favor. So the buyer of said call would not take his shares. The worst case scenario is the stock rallies. They are forced to sell their shares at 135. Remember what they paid for it? 115 was it? I'll go. I forgot the number. The put he sold, and he collected $2 to get there. He gets the profit from that number, 115, to here, and then sell his shares and pocket the difference and keep his $600. And if this dies in his favor, he repeats it for the week after. He goes to the week after and he does it here. So that's buying shares and lowering your entry point by selling covered calls. That's selling covered calls. He owns shares. Once he sells the shares, he has to close this. Otherwise, it becomes short the stock. And that is a no-no, especially not this one. Okay. So that's things you can do. Another way to do it, if I already own shares and I'm nervous, let's say I own Apple and it's at 160 and it's like, oh my gosh, I'm profited so much, I need to be out of it, but I want to stay long. Okay, I would sell my shares, put the money in my bank, and then I would buy a call. Let's go to Apple. So I own Apple. That's the scenario. I'm nervous. I want to book my profits, but I want to stay long Apple. Okay, so I sell my shares. I book my profit. I go out and I say, I want to be long Apple. So I would buy the 165 call. That keeps me long Apple in a sense. I've reserved my price to buy it at 165 if it starts running. And here's the thing. Then I sell the 150 call and collect money. So now the out-of-pocket expense is almost zero because I collect $3, I pay $3 and change. I'm essentially almost paying nothing to be long Apple. Two scenarios. Nothing happens. Nothing happens. I didn't spend too much money on it. It rallies. I'm already long. I didn't pay much for it. Then how do I profit? I can rebuy the shares at 165 or simply sell this one that I bought for more money. For more money, meaning any money is profit because I didn't pay anything for it. I bought it with free money. So worst case scenario, the Apple falls and then I have to buy it back at 150. My break even is 147. So I avoided losing $10 because it's 158 now and I will be break even at 147. So that's called a stock replacement strategy. Because I told you, if I'm worried about it, Brock, so that's the scenario. If I'm long Apple and I'm worried about a drop and I wanted to be long without having all the money on the line, let's say I owned 1,000 shares and I didn't want to be long 1,000 shares out of pocket it and stay long Apple with virtually no out-of-pocket expense. Who wouldn't want that? It's tax reasons. Okay, that's on you, but the same question, Doc, that was a scenario I offered in order to illustrate. Like if somebody said, hey, I have shares, I'm very profitable. How can I protect them? I'd say, are you able to sell them? Yes. Then here's how. I would either sell covered calls or do a stock replacement strategy. What's that? Hey, cash in all your money, stay long Apple without any money out of pocket. The worst case scenario is you end up buying your shares lower. Okay, sign me up. This can be done on a weekly basis. I chose January. I could have done it for June of next year. And the numbers are bigger, so then I have more flexibility. No, I'm not selling the call. I'm buying a call, selling the put. Yes. This is, see, that debate, see how you're going back and forth? That debate, if it's happening in the chat room, it would cause me to say, all right, hold on, Matthew, let me do a video on that. And I go back and I'll do a video and it'll be in slow-mo, 10 minutes. You can go back, fast forward and rewind, all of that.
So in the chat room, if somebody has a question, because it looks like, some people do need like, I'm going to say like kind of one-on-ones, where like, okay, can you explain this specific?
There's no one-on-ones.
No, I mean, in
the
chat room
sidebars, you can direct message
right.
me in the chat room too. We can have that.
Yeah. So basically they can direct message you about a question. I mean, that to me sounds like a
okay, hold on.
Yeah.
Tushar, what do you mean? Tushar, aren't we in big loss if Apple tumbles now? What do you mean? In my scenario, sell the shares and to do my thing? Okay, so stop. So Tushar is challenging me, okay? So here's the scenario, Tushar. I own shares. If the stock falls, I lose money, correct? Yes. Okay, my scenario, I own shares. I ditch them, pocket the money. You can't take it from me anymore, right? In replacement of that scenario, and I want to stay long Apple, I sell a put and buy a call. The net effect is almost zero. So there's no money out of pocket. I paid to buy the call. I sold to sell the put. The net effect out of pocket expense dollar-wise, I'll tell you what that means. is zero, basically 20 cents in this case. And so what happens? If it rallies, the calls will make me money, right? If it doesn't do anything, there was no out-of-pocket expense. I didn't lose money. I can repeat once they expire. If it falls, the call will die against me. It wouldn't do anything, but I didn't pay anything for it. All I did was to sell a put, right? So what does the put sold do to me? It gets me back into Apple at a break-even point of 147, $10 lower. So compare it to holding the shares. You lost $10 per share by that time. Me, I didn't lose anything. I just rebought I have my profits that I booked from selling the shares, and I own shares at a $10 lower. Okay. So it is convoluted. I don't expect you to do this right away. If you want to get wonky, you can double down on a stock without any money out of pocket, but that's another conversation. You know how I say don't average down? There's a way to use options to average down with no money out of pocket, but it's way too complicated to do it here, and it would just turn everybody off. But trust me, there is a way. Okay, so we can agree on one thing. The debate is beautiful. The fact that Tushar presented a question, it wasn't like I didn't take offense to it. I just wanted to drill down to use it as a teaching lesson. So what is the name of this credit spread? Which one? The one I just said, the buying a call and selling a put? Well, the combination of selling the shares, buying the call, and selling the put, Wall Street calls it stock replacement strategy. Flows off the tongue, it rolls right off the tongue. Stock replacement strategy. So there are a whole bunch of things, they put names to them. If you want to have fun, let's talk about iron condors, right? So I have one on Boeing right now, and it's making me money while Boeing is going nuts. So was it January? Let me see here. Anyway, so I did two things. I shared a trade, actually. I shared a trade on Boeing not too long ago, maybe even this week. So what I did is I'm going to go with December. Maybe. So with December. So I said, I like Boeing here, and here's a way I can get long. I shared the ways I get long. And then I said, you know what? This might be a good opportunity to try and do an iron condor on it for somebody that knows what they're doing. So I'll go to December 23rd. Okay, so I said, I'm going to sell let me see something here. If this jogs my memory, maybe December. I think it's 23rd. Okay, so we'll go back to it. So I said, I'm going to sell a put spread. That's a somewhat bullish trade. I collected, I believe, 50 cents to do it. And then I said, at the same time, I'm going to sell a call spread to balance it out. So I'll explain. Don't get lost. I promise I will explain. In fact, it's a little bit higher than this. Wow. Okay. So I'm going to, does this have more? Oh, 40. Okay. Whoever asked me to zoom, I'm sorry. So here we go. I did this trade. I said, I'm taking this trade. It's a bullish position. It does not need Boeing to rally. I just need Boeing not to fall through or to 185 in the next 30 days. I said, for a balance, I'm going to sell a call up here at 255, 260, in fact. So for the net effect, I collected 90 cents, I want to say, from memory. And currently it's in the 50s. So this must not be the contract I picked. Maybe it was 1 week this way. Yes, that's the one. All right, so that rings true now. All right, so this is the contract I have. This is the exact position I have. So I collected 90 cents. It's now down to 54 cents. So I can go out and buy it back for 54 cents, and I would have created 45 cents in income out of thin air. This position is called a iron condor. Simply stated, it's a bullish position called a credit put spread. Also, you've heard it called bull put spread. It's called bullish. It doesn't need a rally, but it just needs no crash. I prefer credit put spread because then credit word tells me I'm collecting something, so I'm a net seller of things. That's smart. And then I also sold a credit call spread. You've also heard it called bear call spread. It's not bearish. I don't need it to fall. I just need it not to crash up. So I need price to stay between these two red marks, and I win completely. So this is a bearish position. I collect premium. This is a bullish position. I collect premium. What's my maximum loss? Can anybody tell me? Like per contract? Okay, I'll get you off the hook. So no, that's my maximum win. No. Okay, let me explain it. So the width of the spread is $5, right? Yeah. The width of the spread is $5. So let's say the scenario where Boeing falls to 0. Then my maximum loss is $5 if it goes to 0, because I'm on the hook from here to here. But I collected $1 for it almost. I'm going to round to make it easy math. Or let's not lie, 0.9. I collected 0.9. So my maximum loss is 4.1. Thank you, Nina. Now, let's flip the other way around. If it goes to $1 million, what's my maximum loss? Yes, yes. All right, we got people on board. So, right, Esteban. So it is a way of doubling my income almost, potential income, and lowering my money at risk. You're saying, what? Yes, if I did this alone, I only collected 50 cents for that one at the time. So if it fell down to 0, I lose $4.50 because it's $5 minus the 50 cents. But then I decided to add another side to it that's bearish. And that's the other side that I just deleted. I'm rebuilding it, no tricks. And at the time, that also paid about 50 cents to get to the 90, 45 and 45, whatever it was. And now I collect double the amount, 45 and 45. Did I double my risk? No, I actually cut my risk lower, because now if it goes to 0, I only lose 4.1. And if it goes to $1 million, I only lose 4.1. I can't lose on both ends. Price is not going to split in half and half of it go down and half of it go up at the same time. So that's why these are attractive. And by the way, I share at least 8 or 9 of these every week on the weeklies. I don't do all of them. I don't do most of them, but most of them win. So all of this week's, however much action we've had, up, down, up, down, up, down, the market said, much ado about nothing, because the iron condors that I shared about the SPX, SPY, RUT, IWM, QQQ, DIA, they're all 100% winners. I had 2 that expired on Wednesday for maximum gains. I have the rest expire tomorrow. They were at almost maximum gains today. Hopefully people closed them, because I like to close cheap risk. I'll give you a lesson on money I'm going to lose tomorrow on something I didn't close. So iron condors are fun, but I worry about this part, and I have to manage my risk. And look at my deltas. It's still at 16. The odds are still in my favor. Now, if price starts to rally and that delta becomes 30, I start to sweat. That's uncomfortable. You're saying, Nick, you still have a 70% chance in your favor to win. Yes, 70 sounds high, but you have to remember that 50% is gambling. So 50%, I have no edge. I'm just hoping for the best. 70 is a little better than just hoping, but it's not great. 85 is good. 90, great. So I'm still good. On top of it, I have money from here, so I'm really good. So I can buy it back, close the risk. So let me tell you a story. What the hell is that company? Freaking Clover. All right. So I had a position in Clover that I wanted to close. I sold the put spread at 7. What does that mean? It means I sold the put spread at 7. I said it's not going to fall below 7. It expires this week. And then they came out with a dilution, I think. Something came out with the headline. Oh, yeah. 300 million shares, whatever. Today they had more details about that. Why do they not release the 2 pieces of information at the same time to cause one pain? I don't know. The headline on the 16th overnight was that they're diluting the stock, and the stock collapsed. Look at the breakout they had, and then the stock collapsed. Okay, you're going to dilute it. I was like, they're going to bounce back, and I'm going to get my money back. But right here on this rally, the put spread I sold, I collected 31 cents for, 32 cents. So I only risked, it's 50 cents wide. I only risked like 20 cents tops. And I got the pop I wanted. So I entered an order to close the position. I didn't pay attention that it didn't completely fill. It left 2 contracts open. So tomorrow I'm going to lose $40 because of that. It's not a big loss, but it is a pain in my side in theory. It's like, Nick, you preach close, cheap risk, and you got caught open. It was 3 cents to close. And for 3 cents, I have to pay 50 cents now. All right. So it's annoying as you know what. And then the second headline came. Look, I mean, it bounced off of 7 and I didn't close it. Second mistake. I figured it was only 2 contracts. At that point, it was a pissing contest. And then overnight today, we got the details about that. And boom, the stock goes to hell. This will be a massive winner if I'm reading it right. I don't know what the details are in the deal, but it sounds like, and somebody helped me out with that the details look like they're handing over money to people who need to get out of short positions. So they're forced selling them the shares at a cheaper, they're giving it a break to get out of being short with a profit. That's what they're doing. So they caused this on purpose to get the hedge funds out of trouble that were short the stock. I don't know if I believe it, but it's a thesis. Anyway, the company is doing okay. Blue and line, this is just a simple regression line. Justin, is just a regression line. And if you use, this is trading view, by the way, and I believe this is a free indicator. If you type regress, linear regression, and I only change the number from 100 to 200, the count, because if you do 100, it looks kind of silly. It's not as meaningful. It's not a trading thing. I don't buy here and sell here. It's just a visual representation of who's in control. Is there a trend, if there is one? So if somebody says the markets are bearish, I was like, how could you say that? Look at it. The market are actually physically bullish. You can't deny that. That's fact. It's not opinion. So if you notice here, I have no indicators. Today I had a discussion. Hey, Nick, what do you think about the RSI? I was like, that's not for me. Does it work? I was like, it works for somebody out there, but it's not for me. Okay, so what about it with the MACD? I was like, I just told you it's not for me. So MACD works for some people. For me, it just lies too often. What about the combination of the two? I said, whatever it is, figure it out and specialize in it. So number one tool in your arsenal should be, was somebody hearing? I'll get to that, Belinda. What's the number one tool? I said it earlier. Were you listening? Number one tool. Yes. Thank you, Justin. Thank you, Dan. Brains for sure. But eyes, hopefully, look left if you can on the chart to find what happened the last time they were there, what happened a little bit above, what happened a little bit below. And then the second part, Modup, is the price action. And that answers the question for Belinda. What are these? Okay, this is called, if you need to learn something, trend is super important, Thomas. If you need to learn something, learn the volume profile. You know how they say price is truth? This is truth. That's price. So these volume bars are cool, but they tell me nothing other than when the action happened. Oh, back there, they were so busy. Back here, they're so busy. Some people can trade that, not for me. I have that same information, but it's here. So I know for a fact, this orange line, I didn't draw it. That's where we've had the most action on the SPY in the last year. Second most, right here. Third most, right here. So guess what? I have an alert to buy long here. I should have an alert to buy long here. I'll explain why. I should have an alert to mortgage the house, the dog, the car, the kid to go along here. POC. Okay, so let me explain what these are. So the information tells me that if we start falling, the highest point of interest, the next closest highest point of interest is somewhere around 440. So if price is precipitously falling, it will find support here, because once it hits here, we know for a fact that bulls and bears love it and they'll fight over it hard. So whatever imbalance is between buyers and sellers, inequalities, will taper here because they're at even strength. Same here, a lot, same here. And in between, there's not a lot. So if they break through one level, they go whoop to the next level. You like that? This is a good spot. When was that? So if you were in the chat room, then you would have known that right here, I said, I'm going to go long calls because I think the SPY is going to 403.9 or 402.9, whatever. The next day, it jumps past 400, gaps up to 403, and never looks back. So at some point, that number is going to come back into play. I never imagined it was going to be that soon and this long, but there we are. We built a whole mansion on top of a stick with holes. So God help us once we actually have a problem with the market. I am not using 13. I have code in here to get me stuff like price to sales and things. So I am not using 13. I have 13 here, but I don't use them. These are the only ones I use, I promise. You can look at all of my charts I publish. Those are the only ones I use. All right. I am about out of energy and out of energy drinks. And what do we do next? What do we have on the docket? Oh, did you want to do a few charts?
Yeah, I mean, do a couple charts there, Nick.
How much time do we have? 5 minutes, 10 minutes?
I mean, it's up to you, Nick.
How about we 6 minutes? We'll end on the hour.
Okay. All right. Sounds good.
Right. Hit me with a ticker. SPX. The volume profile I'm using in TradingView, I see 3. VPVR, volume profile, visible range. So if I zoom in, it adjusts. Watch. See, changes. VPVR. Lucid, we'll do Lucid. We'll do WSM. TTD, we'll do that. Okay, Lucid, WSM, TTDD. All right, so Lucid, I hate the stock because of how popular it is and how cocky they are at loving it. The car is beautiful, but the math is not there. They call it a Tesla killer. Like if I was a boxer and a champ, shouldn't the starter boxer go through the number 10 ranked, number 9 ranked before they get to challenge the champ? Well, at its full capacity, Lucid, maybe it can be half of NIO right now as far as unit sales. NIO does 60,000 cars almost. Lucid at maximum capacity is 34. Great car, just too fast, the expectations. We'll see. Chart-wise, you have a collection of support here. It's consolidation. So the one level to pay attention to is about 48. And the second level where I expect to have a good buyer is at around just under 40. I think the 49.6 should be a challenge for the bulls, but if they can take it out, they can come back to here. On a dip, I wouldn't be a buyer until it goes at least to 34, best at 29. Okay, forgot WSM. We'll get to Palantir. Oh, Palantir, basically, I buy dips in Palantir. 22, 20, and 19 spring to mind from memory. So we're Williams Sonoma. That is an amazing story right there. I mean, I haven't been to one in, I don't know, I can't even remember, decades. Look at the stock. You don't argue with it. This is one of those things where I say it's TH. It's too high to chase and it's too hot to short. So I take it off my watch list and I answer questions if somebody asks me. Now, values. This matters. That's 205. This matters. That's 194. This matters. So you have buyers under 200, between 194 and 200. That's a good spot to buy the dip on a short term for fast traders. A better dip to buy would be under 185. So 180 would be perfect, but under 185, 175, 170, that's a serious buy the dip opportunity. So and if you ask me this, I would usually, I don't have time to do it here, but I would put you a line for you here. And I will say this is a buy the dip opportunity. And it would have several, depends on the speeds you are. I think that's what I said they would be, somewhere like this. All right, so what was the third one? Not Palantir, shoot, I can't remember now. WSM, TTTD. The trade desk. Whoa, Nelly, there you go. So there is a mini support zone that I have not put right here. That's a support zone. It's a pivot zone, which is equals to small support. I say small because look at it. It's visually not right. THTH. So where do you buy the dip? I would not touch it for me until it gets down to here. Me personally, I'm okay waiting it out. The ones on the left, they're called VPVR. So if you type visible, you get that one, visible range. It's volume profile, visible range. They have two. They have one that's intraday. It's called VPSVHD. And it looks like if I go to 15 minutes, it's these guys, the volume profile for every day. But those are paid features. So you still have the one here, but this is for one session. Super helpful. Super helpful. Palantir and Shopify. Palantir. I love Palantir's business. The management is unbelievably strong and represents themselves very well. This is a buyable dip. This is a dip I would buy into this support. Now, if this support fails, I should expect another dip lower. I don't think it goes there all by itself. So in fact, I should remind myself, put a sticky somewhere, to look at Palantir. Look, they didn't. Wow, it's so close. Is that so close or what? Check it out. Look, that's my alert line, the orange. And look how close that candle came without alerting me. That is insanely close. Right there. I'm like a penny away. Wow. So I would buy this dip if I'm not long. How do I buy dip? I would sell a put spread, or buy a call spread. Cisco, since I saw it here, I know I did some charts on it today. Yes. So you've got resistance above. I think it fell today into a support zone. I'm not excited about the company but from the price action, look here, nice strong bounce. They came back to it. They rejected the low. If markets hold up their own, this made no sense to me. I said, what is happening here? And then now it's back to reality. This would be a good entry point. Today's low was a good entry point. I want to remind you that Cisco is no spring chicken, folks. That's a dinosaur survived the dot-com bubble. And it just finally broke out from that cloud in 2019. And if you bought it here, you're not looking left. If you looked left and you thought, oh, mom, it's not time, you're 90, you can't be long Cisco at these ranges, you would have gotten not in trouble. Now you're stuck up here, not you, the proverbial you. Okay, one more, even though the clock ticked. One more. Let me see if one of them pops up. Shopify. Okay. We'll look at Shop. Caveat, I do not trade Shopify in the options market. The single options are extremely expensive and not liquid. So I go to do a spread. It gives me quotes that don't fill, and that pisses me off to high heaven. Even when I get it right, I can't book my profits. I don't need that. So Shopify, great company, incredible business plan, not an obvious entry point. If I wanted to get long, closer to 1500. 1550 is the official bounce level. 1480 would be a beautiful bounce level. Split the difference. 1517, I'll start to get interested. 1550 to 1517, good starting point. If the market's correct, I think it will go to 1440-ish, where it would make much better entry point. Oh, somebody is BKKT, please, because he said please. Okay, that looks like a SPAC. It looks like it. It has no income. SPAC and the $10 level is like love-hate relationship. Nothing you can tell from the chart. It's a falling machete. You just have to do homework and figure out what. The chart is not going to help you. They won't respect levels. I can tell you one thing: the bear is in charge, and pops into 18 should be sold. So if it pops to 20 and that gets you out of trouble, I would bolt, unless you know something about the company long term. The price action, the machines will sell the pops. Cat, please. Okay, last one. I can't do more. We have to say no at some point. But hey, you see how hectic you are trying to get answers? That's what happens all day, any day, all year. Tell me that's expensive. No way. I wish I had that. What are we looking? Cat. I don't have lines. I must. There we go. There's your answer. You got support zone. Hopefully it holds. If not, they go to the next level where I'm pointing down here. If not, that's an alert for me to go long or get out. And then the resistance, which could be a catalyst to here, but I'm not a fan. And then I'm sure you're thinking, oh, what about the infrastructure deal? Never mind that. That's not tradable. SoFi, I would buy the dip. Workday, didn't they report? So we shouldn't talk about it. I seriously can't do anymore. I mean, what? It's down 8%. That's why you want. It's too late to panic on Workday. Doesn't mean it can't fall further, but the easy money for the bears was done. Now it's falling literally to the mean. It's reverted to the mean. So from here to here, slice it in half. Somewhere in the middle lies the truth. If I'm long, I'm not getting out tomorrow. I'm debating whether I want to lighten up a little bit, but I'm not panicking out. PayPal, I'm long. So UPSD, I was long way before the breakout. I wouldn't chase it up here, even after the breakdown. It's just not for me. I can't explain the rally that big. I thought it was coming, but it was 10 times bigger than I thought. So I shared the long and it paid big time for those who took it. But then it went way beyond reasonable levels. And then it collapsed pretty quickly. So I was like, you know what? I'm missing a piece of that puzzle. I'm thankful I caught it right the first time. I'm out. I'll trade it when it comes back to reality. Business is fine with Upstart. It's just the trade price action. All right. Best way to scalp the SPY, be in the chat room. I'll give you minute to minute. And with that, folks, wrap up. That was perfect question on the SPY.
Yeah, absolutely. Great session here, Nick. I know you do this every day for the chat members. So great.
I still have to go write 2 things after this. I'm not going to play. I still have homework to do for us. I have to do 2 presentations still.
And how can they join the chat room, right? I'm posting the link there if they want to join and trade with you. It's every day, 24/7.
Okay. All right. My dog is looking at me sideways here. So I'm going to bail out. I appreciate you being here. The room was big and we didn't lose all of them. They stuck around. Thanks for the help, Rodrigo, there. I sent you an email. There are a couple of people that had questions in the chat room. So if you can get to that, that would be great.
All right. Thanks a lot, Nick, for coming on here. Good stuff. Absolutely. Here. And I'm going to stay here just for a couple of minutes here answering some questions, guys.
I appreciate your help and support.
All right. All right. Sounds good. Thanks for being here, Nick.
Yep.
Okay, guys, if you have any questions about the chat room, right now is the time before we do close the stream. I'm just going to post the link here one time. The deal will expire at midnight. This is the chat room with Nic Chahine. Pretty much what he's doing, what he did here, he does this every day. This was just a sneak peek of what's going down there. So if you want to join, there's a 7-day money back guarantee. So even if you want to just try it out, see if it's a fit, if you want to learn, it does give you education as well. So it is education for options, step by step, holding your hand throughout the whole, process. I'm not sure, Josh, you might have to ask him. I'm posting the link. Thomas, it depends. Make sure you send me an email about that. We'll see if I'm not sure. We'll have to discuss with you. But it is for the full year. So the 78% off that you get today, that is a lifetime discount. So whenever you do renew next year, even if the price does go back up to 6,000, the original price, pretty much you still keep the discount with the 78% off. So it is, a permanent discount. And I put the link there. If you do have any questions, you're welcome, Sheila. Anything else, just let us know. And thanks for being here with us, guys. Have a good evening.